안녕하세요. 실천적 투자자입니다. 지금은 모든 투자자들이 힘든 시기입니다. 그러기에 저희들도 마음의 위안을 얻을 필요가 있게 대가들의 영상을 짧게 준비했습니다. 이 영상 보시고 모두 힘내서 화이팅 했으면 싶습니다. 힘들지만 이 시간도 또 지나가게 될 거라 생각합니다. 감사드리고요. 또 다른 영상으로 찾아뵙도록 하겠습니다.
Stock market, the most important organ is the stomach. It's not the brain. There's always, on the way to work, the amount of bad news you can hear is almost infinite now. So the question is, can you take that? I mean, do you really have faith that 10 years, 20 years, 30 years from now, common stocks are a place to be? If you believe in that, you should have some money in equity funds. I mean, it's a question, what's your tolerance for pain? I mean, the stock market's a very good place to be, but I can toss a coin now. Is it going to be lower 2 years from now? Higher? I don't know. More people lost money waiting for corrections and anticipating corrections than the actual corrections. Well, you ought to look in the mirror every day and say, what am I going to do if the market goes down 10%? What do you do if it goes down 20? Am I going to sell? Am I going to get out? If that's your answer, you should be reducing it today. Well, hey, there's perfect record. I think the 13 years I ran Magellan, the market went down 9 times, 10% or more. I had a perfect record. I went down more than the market. Every time I went down more. So I just didn't worry about it. The point is, would you say to yourself, do I need this money in a year? Do I need this money in 2 years? Do I need this money in 3 years? So my longer term stock market's been the best place to be last 10 years, last 30 years, last 130 years. But if you need the money in 1 or 2 years, you shouldn't be buying stocks. I never looked at the economy. I want to find out, the only thing I would look at what's happening right now. You know, what's going to happen a year from now? What's going to happen to interest rates? I'd love to get next year's Wall Street Journal. I'd pay an extra $1 for it. That'd be very helpful. I don't know what's going to happen in the future, but I want to find right now. Well, I think anybody that's investing in the stock market has to understand, you buy a company. These are not lottery tickets. These behind every stock there's a company. If the company does well, over time the stocks do well, and vice versa. You have to look at the company. That's what you're researching. That's what we do at Fidelity. That's what I do. Well, the data now is so good. I remember when Nike, we owned Nike, we had to wait for the mail to come to our library. Now, when somebody reports earnings, it's telecast all over the world. They have an investor presentation, they show a balance sheet, so information is much better. So theoretically, the individual's edge has improved in the last 20, 30 years versus the professional. The data is there. It's free.
What's the biggest mistake people make, though?
Well, the biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month.
I say basically hold. I mean, the idea that the European news or a slowdown in this or that or anything like that, that would not cause you, if you owned a good farm and had it run by a good tenant, you wouldn't sell it because somebody said, here's a news item, you know, this is happening in Greece or something of the sort. If you owned an apartment house and you got to raise your rents a little, it was well located, and you had a good manager, you wouldn't dream of selling it. If you had a good business personally, the local McDonald's franchise, you know, you wouldn't be thinking about buying or selling it every day. Now, when you own stocks, you own pieces of businesses, and they're wonderful businesses. You can pick the best businesses in the world. And to buy or sell on current news is just crazy. You're in a wonderful business. You got people running it for you. You know you're going to do well over 5 or 10 years. And to think news events should cause you to try and dance in and out of something that's a wonderful game is a terrible mistake. So get into a bunch of wonderful businesses and stay with them.
But you said I said buy and you changed it to hold. Does that mean don't sell, or does that mean?
Well, I mean, if you haven't got them yet, you buy them consistently over time. So you sort of average over time. And I've been buying all my life. I bought my first stock, you know, when I was 11 years old, and it was about 3 months after Pearl Harbor, and Corregidor was falling, and they had the death march at Bataan, and all the news was terrible. It was a great time to buy stocks, and I should have held that stock forever, and I've been buying stocks ever since.
What do you do, given your experience, when you think there may be too much froth, when you think there may be a major correction, even a crash? Do you sell all your stocks?
No, I really don't do anything.
You just show that patience, huh?
I bought them for the long pull, and I can I've seen a lot of recessions, and I can live through them.
What's the single most important thing that you have learned about investing over the past 3/4 of a century?
Patience.
Patience. Expand on that. How do you apply patience?
Well, I buy things for myself and for clients to hold for 5 years, 10 years, because I won't be around for 10 years or any sizable part of it. But
You've fooled us before. You could fool us again.
But you should study history, and history is the important thing you learn. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. One of the things I find a couple of rules I want to throw out that I find useful, excuse me, is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis saying, look, it's gone from 135 to 100. It's now 95, what a buy. Within a year, it was 18. And this is a company with no debt. I mean, this is a company, it was just so overpriced, it went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now I am fortunate this happened rapidly, or I would probably be still caddying or be working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do?
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close. And I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all of these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try to figure out mutual funds they own, and keep adding to it.